Hello, everyone. Welcome back to our favorite day of the week for many reasons. Um, it's the end of the week. I need a break, and it's our time to get together. And I'm glad to be here. It's been a tough week for trend followers, and this is definitely a period where the loose pants. It's why most people don't choose loose pants trading. I mean, come on. I'm sure the vol management has fared much better this week. They've got to have some periods where they're going to do better. So this is probably maybe even the start of their relative outperformance. Hard to say, but so much goes into it. Um, Portfolio makeup and look back periods and things like that. So we'll see what happens, but we're here to support each other and encourage each other to keep going. Um, it should be easy for us since we've had such a good run here. If anybody has questions, please request to be a speaker. And then if you want to send me a direct message, they're open. You can just send it to me if you don't want to talk. Um, I don't have a lot going on this week. I got sick on Sunday for like 24-hour bug. So my friends were telling me, you haven't tweeted in 2 days or 1 day. I'm like, yeah, I stayed in bed like all day Monday. I haven't done that in many years, of course. But I got over it pretty quickly. My whole family started just getting sick one after the other. I don't know what it was from, but a bug or food poisoning. But when I was eating that piece of pizza, it really tasted good. But anyways, I wanted to mention a couple of things. We are recording, so that's good. Apologize for last week's snafu when I cut us off. I learned what not to do when you're on this app. One of the things I wanted to mention was, oh yeah, I made this snarky tweet this yesterday, I think, about Bridgewater, and then I about them doubling down on their short stocks in Europe. And it said all the companies they were shorting are part of the Euro Stocks 50 index. And I sarcastically said, this is brilliant analysis. And I posted my own chart because I'm short the Euro Stock index as well. And I just posted to show you that, the breakout would have gotten short in February or March. Well, towards the end of February, early March. And it's at a profit. And I just sort of sarcastically said brilliant analysis, which means it's not brilliant because anyone could have done it. You don't need to have 1,000 people running in your research department figuring out if you're going to be short Europe stocks. In fact, trend followers have been short for a long time because the trend was down after being long in a very profitable trade for a long time. So some people took that to be, oh, Bridgewater has great analysis, and that chart looks like something Jerry would post. Yeah, well, it does because it's something I did post. It's my chart of when I got in to short the Euro stock. So anyways, just thought that was kind of something I should clear up. We don't want to give Bridgewater too much credit, that's the bottom line. They don't deserve any credit for that stuff. Okay, try to keep your comments to a minute or so. And if I mute you, sorry, but that was the reason you got muted probably, is because your comments went on too long. So with that, I'll bring some other people up.
Who was referring to the alt sector and saying how these pension plans, with $7 trillion in them, haven't been successful at all with their allocations towards alts. And once again, the classic sort of statement where he totally excludes CTAs as these alts. I just don't know what universe these people come from. Are we sort of totally hidden from all of the finance community? Why don't they sort of understand what the CTAs are? And I just don't like this word alts or alternative investments. because I don't like being bundled up with this mob, because clearly we're sort of being included in them, in these gross statements. So what did you think about that?
Yeah, that's right. So they're just going to go down they're not going to go down without a big fight. And the fight is these true alternatives, which I agree this sort of tarnishes us. We do have the more perfect. We're moving towards the most perfect portfolio of long and shorts, currencies, commodities, stocks, and bonds, and you have to wrap trend following around it in order to get those returns from the most of those markets and sectors that historically have not performed well on a buy and hold, and they shouldn't expect it to. And one of my big points is I don't expect stocks to either in the future. I don't expect them to. If they do, great. It doesn't really matter. With my stocks, I'm going to wrap trend following around it as well. It's just too risky for my blood to think that, oh, we have 100 years worth of data that all you need to do is buy the stocks. You don't have to worry about them, about trend following. And when they go down, you just do the opposite of trend following and you buy the dip. Okay, that's great. If it still works in the future, what I do is still going to work as well. And mine is going to work. I mean, there's just no doubt about it. It may not make much money, but I'll be able to preserve my capital, take small losses. And if there's some nice trends, I'll hit those trends. But I'm not going to take that kind of risk and that assumption going forward. And they are. And, their universe, even in the alt space, their universe is private equity, long, short, and hedge funds that trade mostly in equities. And so they talk about commodities a year and a half after they first broke out in the fall of 2020. And it's just kind of sad. And then you got some of the CTAs who go along with this nonsense of describing commodities as a super cycle, which means, once again, it's a fundamental, and it's this way to say, hey, we can buy and hold. It's a super cycle. I mean, if you can't buy and hold in a super cycle, when can you buy and hold? And so a year and a half after, and as the markets have gone a long ways and may have a tendency to sell off here and do some consolidation, or maybe even put on a short trade, they want to sell this fundamental approach. This is coming from CTAs. We have a super cycle. It's a narrative. It's a story. But they truly believe it. And but in the meantime, we'll be stuck there with getting out of some of the grains and maybe reversing some of the crude and energy positions because the trends are reversing and we don't know.
Like today.
Yeah. So we don't know what's going on. We can't really predict. And I think that's the key to all of this, is that you can't really predict what's going to happen. And even as painful as holding on to some of these long-term trades are, it's the consistent application of your system is your best idea going forward.
Hi to everyone. I'm very happy to be here, as I always say. And I want to say that I was very surprised when Jerry said about his poisoning problem, because in Sunday I had the same problem and I hadn't such a problem with poisoning of such level for 4 years. So it's very interesting probability. So, and I want to say about the situation with this sell-offs that it's a great reminder always that it's a part of our system. It's part of our journey. And as I wrote before yesterday, that I was alone in this journey, and I'm very happy that now I have friends and I'm not alone here. And I know from the wisdom of Jerry and Niels how to act in these situations. So I had only my back tests, and I have, of course, confident. I was confident, much level confident of my back test, but it was much more hard to be alone. And here, and it's. I think for me, it was the hardest part to these sell-offs, to leave the trade too early. It was the hardest part of trading.
So, Jerry, do we have a reason for why we had these sell-offs today? I've sort of had my head out of the news today, but why do we have this sell-off in the cotton and oats and soy meal, that sort of stuff?
Oh, honestly, I have no idea. I mean, I don't really try to follow it too much. Every now and then I will check the news for, I guess, earlier this week when we first had that first rally in the interest rates. I checked the news and then I saw Powell was speaking or something. So I don't really. So I guess most people know when Powell's speaking. I wasn't really paying that much attention. I do think it's interesting that what's going on in the markets is that there seems to be a slowdown, coming, and um, everybody agrees on this slowdown except the stocks. I mean, the commodities are sort of weak because they're kind of getting this idea that maybe the recession and, of course, the interest rates are. I think there's just people trying to buy the bottom in those rates and try to get long, and it may work. And once again, I don't know exactly what rate they're projecting, but we're not going to get close to 8% to match inflation or get close to the inflation rate. So I don't know if they're going to be able to, if that's going to work for them. It's almost like it doesn't really matter what Powell says as long as he just talks to them. It's like your grandfather reading you a bedtime story at night. It doesn't really matter what he says. He's just there comforting you. And then it's going to make everybody feel better. But I didn't really, if you read the words, I didn't really see much comfort there as far as we've hit um, the peak in rates, or or we should be confident about the market. But it's just hard to say with these commodity markets. And I think a lot of it too is I can never forget the vol management. And as these markets they're relatively thin, everybody is long the grains. I haven't seen one large hedge fund or CTA that says haven't been long the grains. And so they're going to continue to peel back these positions strictly based upon vol management. And they've got so many to get out of. And then once they're finished getting out of their amount, then the vol is higher. So they have more to do. So their trades create more trades to do. It's just pretend. It's just fiction. I mean, I'm all for fading the fundamentals, wink, wink, and I'm all for just paying attention to price. But when my own trading creates more trades for myself, maybe there's a line there that you kind of want to ask yourself. If I do these trades, those alone are going to make me do more trades. It's all pretty silly.
Yeah, it's very interesting at the moment. There's so much conflicting narrative going on. So I sit there and shaking my head, sort of with these very believable stories towards stagflation or towards sort of a crushing reversal in inflation, and they just seem so beautiful, logical, or whatever. But the good thing is, from a trend following perspective, you don't need to believe any of that. But what you do need to notice is that all of the narratives, the conflicting narratives, what it's guaranteeing is that it's not going to be stable. We're going to have an unstable regime. And I think that's great for trend following.
Yeah, that's the thing to always remember. It's so tough, but you can only think about it. At least I can only think about it in hindsight. That is this whole idea that, as painful as today might be, or any period might be, it's likely to be setting the stage for a very profitable thing. So, as hard as it was, I mean, I don't remember anything more anxiety producing than that COVID period. Um, and yet it was the beginning of a magical period for the trends. But no one was thinking that at the time. It was these trades, that's what I'm interested in. I can't believe I'm losing all this money. And I was just up 10%. Now I'm back to break even. And what's happening to this world? But shortly thereafter, all of those profits were going to be made back, plus a lot more, just by following the trends. But it's really difficult to look at it that way. It's not necessarily impossible to carry forth with your system so that all of that happens to you like it should. It's just hard psychologically to say, hey, I don't feel bad today. I think this could be a great opportunity. I'm laughing because I never say that.
I think that yes, it's psychologically reasons when people see how they earn money, and after that they see how they lose money. But we must understand that things works not with in a such way. Things here in our space works in another way and in our field. So as I have said before, and Jerry said that, and Neil said that we pay price for our success here. Like we pay price for a coffee in a coffee shop. So these drawdowns, different types of drawdowns, it's different types of pricing here. I look at this in such way, but not that when it was trending I was earning, and when it's going down, when it is off, I'm losing my money that I have earned before now.
I like that. That's brilliant. I mean, I think that's really a good way of looking at it. We would never go to the coffee shop and expect free coffee. Well, maybe once in a while, but usually, obviously, anywhere we go, we have to pay. And what do we? But we think, and our goal would be to pay less. But if that coffee was really good, I find the best coffee shops that I can find in New York City, and I really don't ever pay attention to the price. And same here. If we can't expect to focus solely on the price and smoothing out things. And if you're going to win in this game, which should be very hard, all we have to pay is this pain, anxiety, to achieve our goals. And in the long run, it's something we should be willing to pay. We should expect to pay. Do the hard thing, do the right thing. Trading should be hard, and it should be the opposite of what I hear often, which is find a method that suits your personality. To some degree, I think you absolutely need to find a risk level that suits your personality. So I think younger Jerry would have traded the same systems that I trade now, just at a higher leverage point and with a little bit more risk and volatility. But the search for the best way to trade should be actually the opposite of what we want and desire, but it's going to more resemble things we don't like, taking small losses, letting profits turn into losses, a low win rate. All of these things are counterintuitive to what we kind of want and what at least my personality. But I think with all of this stuff that we've talked about so far, it all leads to one of the same conclusions, which is this is hard to do. There's not a lot of people doing it. And we should not complain too much, probably, that there's not trillions of dollars in trend following that agrees with us. It really just allows us to kind of be on the sidelines to a degree and take money out of the markets, and when most people are not really paying much attention to how we do it.
I think maybe unconsciously people feel themselves losers. People are afraid that another people, their friends, their clients, their relatives will say that a person is a loser. But for me personally, I feel that I'm in another field of mindset. I have another mindset, so I don't feel that I don't feel this impact on me anymore, at least a few years, and I'm very happy with this. And I want to say to all the people that this trend following, classical trend following, has it's the most evidence-based strategy, like Neil said, like Jerry says a lot of times. So if so, it's the best strategy, and if you want to be a trader, I'm sure, for me personally, it's the best way. And so when people have 5, 7, 6 years of good track record, of successful track record, nobody will say that he is a loser, I think. And in the end of the day, it doesn't even matter, because he will win in this game. And I think that so we must understand that our long-term winning strategy. First of all, we must think about this.
Yeah, one of the things that drives home to me, and it takes a long time to appreciate this, is that the edge that we derive from trend following is weak. And what it is, it's optimally configured for compounding benefits. So you actually don't really see the benefits of trend following till 20 years down the track, when compounding starts taking hold of that equity curve. And it's one of the few solutions that allows you to derive those magnificent benefits from compounding. Alternative methods, they're very attractive, they're very appealing. They might sort of, in a particular regime, perform very well. They attract a lot of people in. But the key problem, the foundational problem with all of these other alternatives is that they are short-term in nature, and when they fail, that's when your wealth takes a significant hit. So it's not necessarily their success, it's their failure which basically ensures that they can't participate in this compounded wealth over the long term. And for a trader, or for a new trader who comes into the investment world, they never think in terms of what is a strategy that is sufficiently robust to survive over a myriad of different regimes and not sort of flounder, and allow you to be in a position that in 20 years' time you see compounding start taking hold of your net wealth and accelerating it up to the moon.
Yeah, that's a brilliant idea. I mean, I love that. I know the first time you started saying that, I thought it was just great. I think, on one hand, it puts you in the proper mindset that this is a very long-term game, and you need to be in it for a long time. That's one of your bottom lines: survive, stay in it, diversify, take small losses, use moderate leverage, cut back those positions when you lose, if you have to. But it is a little frustrating, because in this day and age, or for any day and age, we kind of want success and fame and glory quicker than 22 years. Hey, just wait 22 years. You'll see what it's like we were raised a bit, like our parents raised us, like, you'll see the benefits of all the stuff I'm making you do with your homework and your, all the things I'm training you to be a proper adult. And you're like, no, I don't want to wait. I don't want to do this homework. I'm never going to use this. This is something the kids say in high school or elementary school. Why am I studying this? I'm never going to use it. And then you get to be an adult and you're like, damn, I wish I knew more about that, because I'm kind of interested in it now. And so, yeah, it is, from day one, I would always think about trend following ideas, and philosophy was sort of could be a sort of similar philosophy of life in some areas.
I want to say the same. I want to say that our trend following philosophy and success in general requires such things like long-term horizon first, then discipline, patience, discipline, be open-minded, have a lot of research, and strictly following your rules. It's a discipline, of course. So it's very important in every field, I think so. And of course, paying the price, and in every field that, maybe almost every field that I know, if a person want to be successful, it's, as has said before, it's a price for it. And it's like Jerry said, do the hard thing, do the right thing. It's not for everyone. And most people want another type of success. So if you ask a average person, do you want to be rich? Do you want to be famous? Maybe he will say, yes, I want. And if you tell him, do you want to do some things for this? It's like, as I have written, as one business coach said, that every person knows how about the diets, different diets, how to be in a good shape, physical, but there are a lot of very fat people in the world, because they don't do it. In fact, I like it.
Yeah, this need for immediate gratification is what gets investors into so much trouble. It's either investors or it's traders who come to this world and they say, what's working now? They only want to be concerned with what's working now. And that's totally contrary to what we do, in that we've got to be very patient. So patience is key for our technique, because when we commence our systems, we don't know what's going to happen, the next week, the next month, the next year. We're simply patiently setting our traps, waiting for these outliers. Whereas alternative investors, they come into this market saying, what's working now? They'll do a back test to see what's working now, and they'll get caught in this inevitable trap that the market is not consistent in delivering continuous returns, and they're therefore going to fall on a weak strategy or a weak method that is simply sort of the regime of the day, and they'll get destroyed in a short term. So this trend following philosophy, I think, tends to come to us later on in our lives after the school of hard knocks, where we can start really appreciating it. And I do think experience counts here, because you really need to be a participant in the market for many, many years before you really appreciate the philosophy.
And this idea of what we can, I fully agree with this, and I have seen this many times. And I have told in the last our conversation that I know one girl, and she invested money in a fund, as I remember, cryptocurrency fund with 30% profit a month. And I said that it's a very bad idea to do this. It's very, very, very risky. And she said, yes, but in a 3 month, I had returned my money back. So I didn't risk. But we as investors, all investors must think, first of all, about their investment horizon. What will be, and this girl is a businesswoman, and so she must understand it, that what will be with my money in 3-4 years. And if we do a little math here, in the very best situation, we will have no profit if we will not. So we will lose all the money we invested in such fund. It's maybe near 100% probability. And so if we keep investing, we will be in a very losing situation. If we will not keep investing in such fund, we will lose all our money, but it will be, so it's near 100% probability of losing all money in 3 years. So what is the sense of investing in such way? No sense.
Oleg, I have a question on that one. Now you're saying it's near 100% probability, right? But that's, if I'm assuming it right, that's over the long term. So what would you say if someone says, okay, it's 100% probability, but that's if you do it over time? And what if I just do it for 30 minutes, or if I just do it for a few days? What's your response?
My response, yes, I have a strong response here. Yes, and people also, it's a very good question, by the way. People say something like this always, especially in Russia, where no finance education, almost. I want to say that we don't know when this strategy will ruin your account. Maybe it will be in 1 month. Maybe it will be in 10 months. Maybe it will be tomorrow. And so when you put your first, say, for example, 100,000 United States dollars, when you put it, you don't know when you will lose all your money. And maybe, so you have a probability that you will have your money back. And so it's a luck. It's only luck. Will have only math says that if you will play in this gambling game more than 1, 2, 3 years, you will be in a losing situation. And here, when we are talking about 2-3 days, math maybe say nothing. It's only a matter of luck. If you are a lucky guy, maybe you will take your money But what's the sense of it? Yes, of course. For example, you have put it 100,000 of United States dollars. In a month, you will have 1,030. You will have 30,000 of United States dollars. But it's not guaranteed. Maybe you will lose your $100,000 maybe in 3-4 days, because if you have a profit, if the system have profit 30% a month consistently, especially without drawdowns, it means that math says here only that can be a losing situation in every minute. But about 2-3 days, I don't think that, as I said, math say nothing, maybe on about 2-3 days, maybe only this, that in every minute, it's not means that if this, we have a very risky leverage. So risky situation means probability of losing all the money in every day. Every day probability of losing all of your money.
Hey, hi everyone. Glad to be here. Sorry to be a little late. It's inflation day here in Brazil, so I'm changing my hats right now, putting on the trend following hat. And I like it a lot what Oleg just said, and trying to make some connections with what Richard said before. Perhaps this is another mirror between convergent and divergent strategies. In divergent strategies, we may lose some money in the short term during days or weeks or months horizon, but in the years horizon, we're almost guaranteed to make money. I say almost because, well, nothing is certain, right? Whereas in convergent strategies, these kinds of strategies that Oleg was just talking about, you may win in a days or weeks horizon, but what you're almost guaranteed if you're running too much risk, well, risk enough to make any difference in your daily or weekly horizon, you're almost guaranteed to ruin. You're on a path of taking too large of a gamble, and all the markets go south right in your face.
Yeah, Bruno, I've done a fair bit of studies on the level of randomness in the market, and there are two things going on. There's randomness and there's leverage, and so convergence. What I tend to think happens is that there is a genuine confidence attached to a convergent trading style, because over the regime it's very successful and the risk is hidden, so you don't see that negative skew in that convergent strategy over the time in a successful regime where it's doing well. So it inevitably leads the trader to add leverage, thinking that there is no latent risk hidden away in that strategy. All is revealed. So when you put leverage on top of convergence, that's what really crushes the convergence strategy. But the level of actual edge, unlevered edge in a convergence strategy is far lower than the level of edge that exists in a trend following or a divergent strategy. And this is where I think that divergent strategies and our method of diversification, our method of keeping our risk bets small, etc., actually responds to that need to reduce our leverage or reduce any sort of adverse risk. And I really think that leverage is probably the key problem associated with the death of most traders. And whether it's convergent or divergent, like even in divergent terms, you could have a very successful trend following strategies, but if with the level of volatility, if you go to very high levels of leverage, your drawdowns can take you to risk of ruin with that level of volatility. Like, we see Paul Mulvaney's fund. He's got a very sort of fine grip on the level of leverage he has, but he has got very high volatility. But if he, tripled his leverage, you could see quite easily how, despite the success of the underlying strategies, unlevered, that level of leverage and that volatility can lead you to risk of ruin. So I think the key here is that there is so much randomness in the market. They are efficient, but it's probably the leverage that gets people into trouble most, I think.
And I want to say that we are here maybe losing friends. It sounds very good.
I wanted to note as well that for what you mentioned, Richard, on the compounding being extra good with divergent strategies. That's also, I guess, because divergent strategies have the asymmetry on their side, whereas with convergent strategies, it's more linear, right?
That's right. That's exactly right. Look, the bottom line is that theoretically, the smoothest of all return streams is the risk-free rate. And when you look at that, it's an incredibly smooth profile. That's the Treasury bond or the Treasury bank bill, and it's an incredibly smooth line. However, it's got no lifting power, very low returns, but it's incredibly smooth. And fundamentally, that's what's happening when people try and smooth their equity curve. They're actually sacrificing the beneficial non-linearity in the uplifts for smoothness. And that's where they sacrifice their compounded annual growth over time. Because with a volatile strategy, you need these outliers, the asymmetry of those outliers, to quickly bring you up to a new high watermark. Because if you stay in drawdowns for a long period of time, over that entire period of time, compounding dilutes. So you want to lift your curve as quickly as you possibly can to get the benefits of compounding over the higher curve, over the term of the history of your performance. And that's what a divergent strategy offers in this asymmetry with these outliers, and why outliers are critical to the story of compounding. Everyone talks about the drawdown as being the major feature of poor performance of compounding, but really you can accommodate that drawdown or the drag of the drawdown with that non-linearity of the outlier that lifts that equity curve very quickly. So you'll see a profile of a trend follower has a drawdown that slowly goes down in a sort of a linear way, step by step. It's going down, it's going down. It's not going down in a non-linear way unless you've got excessive correlation, positive correlation in your portfolio during adverse regimes. So it's a slow, gradual move down into drawdown. And as you're moving down into drawdown, risk is being released from your portfolio. So the drawdown slows down and ultimately stops. But alternative strategies have a very quick drawdown. And because they've got so little lifting power, they stay in that drawdown state for many, many years. The S&P 500 had a drawdown in 2008, and I don't know how many years it took to recover. But all of those years was compromising the compounding effect because it had such little lifting power, relatively speaking, to what we can achieve with our divergent strategies.
And I want to say here that trend following, as I always say, trend following philosophy is a great philosophy, as I see it. And when we are thinking about smoothness, we are going away from this philosophy. So we are choosing between smoothness and something that looks good and real trading evidence-based, maybe for decades and even centuries-based strategy, effective strategy based on a great philosophy. So here is a choice. And that choice to look smooth, to look good, it's leading to nowhere, I think. And if a person wants to look good here, to look smooth and don't think about long time horizon, it means that probably it's not the best idea for him to be a trader. I think so.
I think this is quite good to highlight as well. So with the divergent strategy, the compounding effect is very important, and those come from a few or a smaller amount of trades than in the convergent space. So in effect, when you have these outliers and when you want to smooth it out, you're actually mitigating or you're reducing that which is actually lifting up your strategy as a whole. So it kind of highlights where or why letting your profits run, letting those outliers run, the asymmetry effect, how that is important to not tamper with. And I guess that's why there's been a lot of voices like Jerry has mentioned and others as well. Not everybody agrees, but where the volatility management or tampering with those trades will actually reduce that compounding effect. And therefore, your advantage in that strategy is greatly reduced. So it kind of goes back round in circles, showing the importance of letting your profits go and not tampering with the system once you enter it. Obviously, before you enter it, you can obviously have your ATR or your valid volatility where you price your position if you do that way. But after you put the trade in, just leave it. Not everybody agrees to it, but it to me it highlights again that point.
Good morning. I hope everyone else is well. I was just listening everyone else's comments, and in my trading journey at the moment, I'm running a quant system, so every element of my trading is actually coded. But in these days, I'm finding it difficult to let it go and give the entire control to the machines. So one of the challenges for me is stick to the system. Okay, so there are so I've got my brain, I've got the machines. So machines are doing the entire job while trading. So, and the challenge is, when I see a good opportunity to do something else, for instance, to scale in on an existing trend, I find it extremely difficult not to take that trend. But that's where I am at the moment. So I'm not taking that trend, but there's a inherent competition between my brain and the machines, and I think. I would love to hear from other participants how they actually manage their own trading, whether it is 100% machines, it's 100% code that makes all the decisions, or whether they actually incorporate their judgment, which I call the brain, brain versus machine. So you would think that the brain plus machine is bigger than the machine, or you are just a pure modelist and you think that after you code the system, you don't touch it, you only improve it over the years by doing, further tests and further code, so the machines actually can do the entire trading.
Brilliant question. I love that. Brain plus machine. Yeah. I think I'm going to just jump to the punchline. No, brain plus the machine is not going to be better. Trend following plus nothing. I mean, you have to, trend following meaning rules-based, systematic. You're probably going to end up doing trend following if you're committed to rules-based, systematic, back testing, something you can prove. Adding the brain, I mean, that's the emotions as well. I don't think it's going to work as well. There is this cliche that's on people's websites that it's something like, I think it's maybe a Paul Tudor Jones quote. It says something like a man plus a machine is better than a machine only, or man alone, machine alone, man plus machine is better. I mean, to the degree the man or woman has to be involved in setting the machine up and then walk away, you're done. Yeah, it's not going to work that way. One of the most important things about trading is to be systematic, and then being systematic, the important thing is to do all of the trades and follow the rules all the time. So you can never add this random discretionary idea to a systematic approach. It's not going to make it better. It may make this particular trade better, but it's more like you should never do it again. If you got lucky on some discretion or some human thing, the brain, then count your luck and say, I'll never do it again. That you may survive, but I'm pretty sure that adding anything to your trend following rules, like I don't really think adding a second rule is good. One entry, one exit, and a stop loss. Two exits, if this happens, then I'll get out of exit number one. If something else happens, I'll get out of exit number two. There you split your sample size again. And so I don't think that is going the right direction robustness wise, and it's probably a little overfitting. Now, having those in two separate systems, so I'll exit one, I will get out in system one, exit two, I'll put that in system two, that's fine. But combining them and then saying it has to be both conditions, that's fine as well. System exit condition one and system exit number two, when both of those occur, that's not so bad. You have reduced your sample size a bit there. But one and two, whichever one gets hit first, that is no good. It reduces the sample size. Plus, it makes it difficult to understand. You're going to have to do some more work to figure out what the sample size actually is. So, yeah, I'm not in favor of the brain.
Let me jump in here and just ask a clarification question, and that is it a very active, meaning short-term system that you trade, first of all? And also, how long have you been running your system?
Niels, I was actually, yes. So I'm a trend following trader. So I just don't want to create a lot of, how do I say, emotions, but I do things a little bit differently on my end. So because as a quant, yes, you can trade more on the short term, and you can do things that a human cannot do, pretty much. So that gives you coding everything else 100% allows you to do certain things. Basically, more on the short term is, I would say, yes. And the challenge is there's always an opportunity there, and I find that my brain is competing with the machine that I have created, and that's an internal struggle that I go through every day.
And that's actually what I want to get at. So just before I give you my answer, so it's on the shorter term. So that means to me that there are going to be a number of trades on a daily basis, for example, compared to maybe a longer term system where there are going to be days where there are no trades at all. But the other thing I just want to understand is, how long have you been running the system?
I'm a new trader, so Jerry knows.
Okay.
I'm running this thing since the beginning of the year, but
Okay.
it has taken a few years just to code it.
Sure. But that explains it, and I think that is the answer to your question. So two things. I think that it is what you're feeling, I think, is completely natural because of the fact that there is a lot of activity in the system. And I think the more activity we see when we run our systems, I think the more we are dragged into kind of this emotional wanting to get in there and be part of it, and so on and so forth. And I think it also encourages this sort of trading mentality. We call ourselves traders, but in reality, we don't trade a lot. So I think that's one thing. The other thing, I think, it's just time, because when you get to a point where you completely trust your system, having done it for a long time, you will end up in a kind of state of mind where you just simply trust the process, and then you're going to have no inclination to get involved in it because you know it's going to take care of you over the next 10, 15, 20, 30 years. Despite the fact that, and this is the thing, the hardest thing with trend following is that a trend following system can't anticipate, but we can as humans. So we're always anticipating what could go wrong or what could we do to get in early or whatever. That's what we need to leave behind and just completely give ourselves to the process. But I think that is something that will come automatically with time. Of course, I'm assuming here that your systems will do what it's meant to do, right, as a trend following system. So I'm not saying it's going to make money for the next year, but it's going to behave like other trend following systems and make money when there are trends. So you obviously started at a good point in time, I would imagine, if you started earlier this year. But so I think,
that's correct.
Maybe slow down. If you can slow your systems down, that may help you. But other than that, just keep doing what you're doing.
Thanks, guys. Thanks for the inputs.
I think that the brain versus machine argument, there are certain things our brain does incredibly well. That's conceptual development. And there are certain things machines do very well. So I split my effort into my brain doing all of the upfront research, deciding why trend following is the most suitable strategy. So I adopt this, what I call a design-led approach to all of my system development. So what I do is I say, let's examine the market data. Let's examine the nature of that data and the distribution that data produces. And then which edge in that market data do I wish to exploit? Do I wish to exploit the tail environment of that data, or do I want to exploit the area about the mean of that data? So that therefore initially separates. With using my brain, I'm immediately saying, I want to exploit the tails of that data because my research tells me that the tail regions are persistent universally across all liquid markets. And I'll say to myself, that region around the mean is specific to a regime and is timing dependent. So my brain's sort of already decided that I'm going to be exploiting the tails. And then I engage this design-led approach where I first design my models to capture the outliers and to cut my losses short. So the models are simple in design because I don't want to overfit my results. Therefore, I need very simple system parameters. I need to test how many parameters I can do without to get it as simple as I possibly can, to get what I call this loose pants sort of philosophy. That's all using the brain as a logic space. And when you do your designs like that, what you do then is you are confining your trades to a map of possible states within the trend following logic. Because if you let the machines work out what system you want to deploy, they're going to come up with an overfit result that could be a blend of convergence, divergence, or it could be just responding to the market noise in that data. So you do need to take a position about what edge you want to exploit, how you want to exploit it, and you need to develop the constraints of that model, which I call the golden rules of that model. Where, if there's an initial stop, where is it? If there's a trailing stop, where is it? If there's a profit target or a no profit target, if there's an entry, where is it? All of those things are defined by logic, and then that defines a system parameters within which I then want to test using the data, using the machine's power, the robustness of that model. So that's where my brain then takes a relax and I say, right now, go machine, you can do this a lot better than me, crunch all of that and tell me how robust it is and whether it's viable. The machine, after this extensive testing, comes back with a validation of that hypothesis that was created through my brain. And then once the golden rules have been validated through sample size, and that my hypothesis has been validated, that's where I'm confident that I've got the best of both worlds. I've used my brain creatively and conceptually through logic, and I've used the machine's brute force through power of assessing that logic and defining whether those rules are valid. And then I've got an incredible level of confidence going into unseen data, knowing that I know how my designs are going to respond because I designed them that way. I know the thresholds within which they operate, the level of loose pants they all have. I intricately know my systems. The machines haven't developed them for me. I've developed them up front, but sort of define the constraints around which those systems work. That's how I get confidence in my models.
Let me just ask this one question, or I was going to say, maybe one other point to look at, and which has been mentioned, is the complexity. Because I heard you say that it took you a few years to create this system. So maybe it is in a certain complexity where one mistake in one code could almost mitigate. So that might be something that's in your mind. So maybe it's also worth looking into simplifying it if that's on the model. Because obviously with coding, you can have the risk management system, which you could have taken time to create, or is it the actual model? I'm not sure if it's the model or the risk management system itself. But yeah, try and look as well on the complexity side of things if it's too complex.
And I want to say that I think that first of all, I'm focusing on my system. So I'm focusing on the logic that lies behind the system, and use my thinking ability, of course, creative ability maybe. So it's ability of the human resources. And after that, I think how computer can help me with this, with the statistic maybe and something like that, but I'm not very good in coding. And in fact, I don't feel that I need this. And at least in a strategy, trend following strategy that is a long-term strategy, I'm sure that a trader can be very successful without coding. And on the opposite to this, I can say that if a guy is a very good coder, very good in IT field, but he isn't but his system is not good, and he will code it in the best way. I think that, like Moritz once said, you can code a total nonsense. So first of all, of course, is the knowledge of a system. Understanding the logic behind the system, as I have said before many times. And after that, thinking how computer can help me with this statistic. I'm sure it must be so.
Hi, Richard. How are you? Can I ask you a question about what you just said about divergence and the hypothesis of how the market works? You say that when you start, you have some ideas, for example, about the tailiness of the markets, and that's why you have outliers, and that's why trend following works. If you apply good risk management practices like stops and a proper amount of leverage. But in a very, very high level, I think that this will always work because of human nature, and that outliers will always exist. At the same time, there's like a Popperian way of thinking to say, okay, why don't you falsify that? I mean, why aren't you asking yourself, did this change? I mean, is there enough outliers, or is the market divergent enough? So my question is, do you ask yourself that question all the time, or do you settle that up and you say, okay, I won't ask myself anymore if this thing is divergent, if this thing is not normal, and if this thing will continue to be this way?
Yeah, look, if I introduce a new market into my portfolio, and I'm actually introducing 6 at the moment, I do have a checklist I go through to ensure that my hypothesis is still valid. So when I, for instance, first did this exercise going into why trend following, the first thing I did was I did these very extensive long-term data tests on markets, on the market data itself, not on the system, on the market data, and identified whether each of those liquid markets had a tail. All of them did. Every single one of them did over a 30-year time frame, but 30 to 40 years. But anything less than that, it was quite often the case that you didn't see that tail nature of that distribution. So you need these very long-term data sets. So every time I introduce a new market into my system, I do a cross-check where I ensure that that market does have that tail feature. They all still do, so I'm very confident that every liquid market still has this propensity to offer outliers, even some that we struggle with, but I'm confident that it exists. So therefore, I'm confident that this universal phenomenon that we're talking about, whether it's behavior, whether it's JPBs, endogenous factors, or whatever the reason, I'm confident that that is a valid signature that exists in the market data, and therefore I know there is a method of system that can be used to exploit that feature. But it's a system that has to be deployed under extensive diversification, because the level of tails in that market data is not sufficient under limited diversification. You must have massive diversification. And when I say massive diversification, there are two things going on here. Well, firstly, there's massive diversification across markets and across systems, but also you want to reduce the trade frequency for each of your return streams, because the vast proportion of the market data for every single market I've assessed, the vast proportion comprises noise and mean reversion. The vast proportion plots within the bulk of the normal distribution. The tail features are quite limited. Therefore, you must have massive diversification, but also you must prevent over trading. So through this extensive diversification, through long lookbacks, what you're doing is you're reducing your propensity to be sucked into any individual market and only trade when these markets get trend in a material nature. And therefore, by reducing the state of possible market states to only those times when trends start getting material, you find that you actually reduce at the portfolio level the total possible level of market states that you participate in. That's the key, because if you try and trade at all times during the market, you'll be burnt up and eaten out by noise, mean reversion. So you want to have a strategy that excludes trading possibilities within the normal distribution and only participates on the edge of those outliers. So there's this fine line in diversification between going as wide as you can, because the intent of that very wide diversification is not to get all the outliers happening at the same place in your portfolio. You want those outliers spread right throughout the time series if possible. Now, in reality, that doesn't occur because these outliers tend to cluster. But the more you diversify, the more you get these outliers being spread out across that time series of your portfolio distribution. And if you get that spread out nature of that portfolio distribution of your outliers, the compounding starts really kicking in early, as opposed to having to wait 10 years before you start, getting a lift in your equity curve. So you want a distribution of outliers right throughout the time series of your portfolio, and you can only achieve that through massive diversification, both in terms of system and in terms of market.
I was just going to say, I remember Richard saying that the reason why he used some of the criteria before he picks a market is because he can't trade all markets, right? So that's a caveat maybe to say that it's not the case that, if you could trade all markets, you would trade all markets, or is that incorrect?
No, that's correct. So obviously there are the practical limitations of trading, your level of capital, and your broker, the brokers you go through, and the restrictions that they place on you. They place practical limitations on what you can achieve. The idea being that theoretically you want as much diversification as you can with as small a bet size as you possibly can. That's the aim, but the practical limitations prevent that. So when those practical limitations prevent that, you've got to have a method of selection which excludes opportunities, unfortunately. So your process needs a method to be able to have a process of exclusion.
I want to jump in and a couple of things here. Pete, I'm trying to add Pete as a speaker, but it's not letting me, Pete. So maybe you have to log off and come back. I'm not sure. I've seen this error on Twitter Spaces before. I wanted to sort of say that I don't agree. I agree with almost everything Rich said, except this one part. I definitely don't agree with this. In fact, I got questions from some friends this week, like, explain to me how you choose your stocks. And I'm trying to paraphrase what Rich was saying. You can correct me when I'm done, Rich, but it was something like, I want to ensure I'm adding 6 markets, and part of my process is to ensure that they have this tail feature. So I don't really do that. No, I don't care about the historical performance in any way for any market that I add. I don't look at it. I don't care. I remember I don't require it to be good or have a tail feature. I've told the story before where a few years ago I switched out my stock universe because all I do is try to make my stock, commodity, currency, and interest rate portfolios and sectors as diversified as possible. So that's it. That's nothing else. And I'm not going to get too fine-tuned into that because you know there's a contradiction there. Well, how on one hand can you say you're seeking this diversification, but then on the other hand you say you trade crude, heating oil, unleaded, gold, silver, and platinum, copper, aluminum, and zinc? Well, they add a bit of diversification even though they're highly correlated, but I'm obsessed with hunting outliers, and the diversification suits that purpose because every now and then heating oil will double or triple and crude will sit there. Okay, so I ran this when I adjusted my portfolio of stocks 5 years ago. My research people said, "Hey, we just did the back test on these new stocks. It dramatically hurts our performance." I said, "I don't care. It's not about historical performance or a tail feature or what's happened in the past. It's only about increasing our diversification." Not obsessed with the diversification piece, but we're going to try to have it both ways. But our ultimate goal is the hunting of more outliers and getting up to 200 markets and trading and having 200 really small, tiny bets. Now, another caveat to that is I will not trade indexes. I don't care if the index historically has made lots of money. There has been times where the S&P or the Nikkei or some index has made lots of money. Well, that adds diversification. Aren't you going to add that? No, I don't care what the back test says in that regard either, because indexes are not going to help me maximize outliers. I'll trade the components of some of the indexes. I'll trade currently, I'll have in my portfolio Microsoft, Amazon, Google, and maybe one of the other ones that make up a large part of the S&P. But I'm not going to trade the S&P, because I'll get an outlier in one of those markets quicker and more reliably than I will the S&P itself. So I know people just ask me all the time, how do you come up with these stocks? And I'm just like, it makes no difference what they've done in the past. Likewise, I'll trade wheat or cocoa or bean oil, which I think they're probably three markets that have underperformed almost every other market in my 200 market portfolio historically in terms of performance. And the British pound might be the worst currency. So why don't you kick those out or only include the ones that have done well over the past 4 or 5 years? No, that's not how we do it. All trades are the same. All markets have the same expectation when you trade them with the same systematic approach. Go, Rich.
No, look, see, I agree with that, Jerry. And all I've said was that I will test. What I want to do is I want to ensure that this logic that I'm applying is sound. So I'm saying exactly what you're saying. I'm saying that any liquid market is a bet for a diversified portfolio. But I just want to test that assumption all the time because so far it's been universal. And therefore, what you're saying is totally right. You can afford to trade any liquid market. However, we do have to be careful of liquidity in our markets. So that therefore eliminates some equities out of that because of their illiquid nature. And we've got to, so there are certain key requirements in that universality. Liquidity is one of the features. And secondly, you do need to pay attention to spreading your bets across asset classes rather than investing all of your efforts in one asset class. So there clearly is a correlation at the broad level you do need to take account of. That's all I'm saying.
Oh, very good. But just one little clarifying thing, and that is the point you made that really I think you made was that the reason you can have it both ways is because whenever you've tested a market before you've added it to ensure this tail property, you've I'm guessing, had 100% of those markets, they always have that property. And that probably means you're using a fair amount of data, not 3 or 4 years. I was adding stocks that were maybe 2 or 3 years old and not enough time for that. I think one of them may have been Tesla. So my research people were saying, hey, Tesla doesn't look that good historically. And it's not like I'm some genius. Philosophically, I'm like, I don't care. Philosophically, I don't care. And boom, it's like one of the greatest of all time. But so if you're looking at all, I'm not surprised at all that with enough data, 10 or 15 years worth of data, so far, it may not happen all the time, but probably most markets are going to have show some outlier with given enough data.
And I want to say that, of course, we all know this, that all markets have the same ability to move. And of course, I always say this, and I will say it again, and will say it again and again, that I'm sure that it's the reason of that is general laws of nature, as I see in general in nature. So all the markets have the same ability to move, and as we all know, maybe for 15, 20, or maybe 30 years, all the markets, like Niels said, that if we look at the chart, 50 years chart, maybe we will not find any that was not moving, that was not trending. So the price, it's a quality of price to be changed. So,
but going to the definition of market, do you think that the equity indexes are not a market since they don't have that property that everything else has? I mean, is it different? For example, what I understand, Jerry, is that you say it's indifferent for me to trade, for example, Tesla than to trade McDonald's. It's just an issue of implicit leverage, and I will adjust accordingly. But it's not the same for me to go and trade the S&P 500 because that's an exception. That's an exception that doesn't have the proper attributes to make it a proper market that has outliers and tail characteristics.
Yeah, it's not going to have the same type of outliers because what you've introduced, well, I don't know if it's legitimate either. Is it legitimate? Obviously, overlaying trend following on Tesla, it's totally fine. It's what you do with all the other markets. Then laying it over top of McDonald's, same thing. But somehow concocting an index of those two and overlaying the trend following on that, is it a real market? Is it? I don't even know if that's legit. But then what it essentially does is it introduces diversification into that instrument. We don't want our instruments to have diversification within themselves. We want to add the 200 markets together ourselves, and then we create this diversification of our portfolio. But I want a wild and crazy market, a stock or commodity that has no diversification. It's cocoa only. That doesn't sound very safe. It's not. Trading cocoa only is only safe if it's 1 out of 200. And so I want a company, for instance, that's not diversified. It has one product line. It can have supply and demand issues that kick off a big trend or consolidation, but then the possibility for this big trend. And so adding all of these stocks together and trading them as one individual market is far different than trading each one of those individually. They have their own ATR. They have their own chart pattern. The amount of diversification that's lost in trading the S&P versus the S&P components is crazy. I mean, it's one market versus 500. And is it legitimate to meld together 500 different equity curves and trade that only? I mean, why not just take my 200 markets and assume that they're long only and then trade that? Create an index of it's silly. I mean, it makes no sense. So it shows up in the data. My explanation may not hold up, but it shows up in the data that you're not going to get, you'll make more money trading the individual components than you will the index itself. Now, the reason the shorts work better on indices is because of that diversifying nature of an index. All those stocks added together, they diversify, and what they do is they tend to reduce the ATR, and the ATR is reduced to a level that the shorts become more juicy than going short a single stock. That's a unique part of stocks, which is that their ATR is higher as a percentage of their price than almost any other market. So when you go short, you have on a very small position. The indexes allow you to have much larger position because part of the ATR is being impacted by diversification. And as Richard said, and I agree, that you have a tendency to see some sort of outlier in the short indices because of this panic that can happen where everyone starts selling and the correlation goes to 1, and you may ironically see more of an outlier on the short side.
Hey, I want to jump in here.
Jerry, can I just, Bruno?
Sure, go on.
No, it's just going to follow up on that with Jerry. I mean, with all due respect, isn't that cherry picking a bit and slightly inconsistent with the philosophy of trend following, saying I'm only going to trade the indices to the short side because that fits better? And for two reasons I asked that. One, if you only do the short side of indices, we're not going to have a lot of sample size on that. So that's one concern. And secondly, I agree with what you say about we want these extreme moves that only the individual equities can provide. But on the other hand, I wonder if you were to trade also the indices, just both long and short, the fact that they are less volatile, perhaps that would actually allow sometimes the models to stay in the trade for longer. And then even though the move might be smaller percentage-wise, well, the volatility would be smaller, so the position would be bigger, and therefore the P&L could actually be meaningful. So I'm just wondering on those two things.
Yeah, okay, don't let me forget both of them. But but your keyword, the keyword you threw in there on the second question was sometimes. Yes, of course. Because if you throw sometimes in there, then you're always right. Yeah, of course. Sometimes. Yeah. But we don't live in sometimes. We live in looking at all the data over the back test and what works overall. And I don't think there's any good reason to, on purpose, torpedo ourselves by trading the indices. We know ahead of time. Just trade a few more stocks or trade a few more of something else. And so we know over time in the back test that the indexes don't hold up very well on the long side as compared to their components. But sometimes, oh yes, sometimes every bad idea is going to work every now and then. But you absolutely have me dead to rights on the first question. You're totally right about that. It does violate. I think it's important to remember that you want to be consistent and disciplined, and as much as I try to promote systematic trend following plus nothing, it really always comes back to a legitimate back test and the sample size. So in those areas, I think you're 100% correct. But I do think sometimes I do cheat, and that is a little bit of cheating for me. And I was glad to stop doing that about 4 or 5 years ago. Then I brought it back into my portfolio a few years ago. So who knows? I may take it out again. But
but maybe the answer is, Jerry, if it works for you, it works for you, right? I mean, that's the main thing. If you believe that this is the best way for you, then I think it's perfectly fine. I mean, we don't have to all do trend following the same way. That would not be right.
I would connect with what Rich just said before. it comes down to the decision of would we trade all the markets if it was possible, if suppose everything was tradable and everything was liquid, would we, and suppose also that we didn't have any capital restrictions, would we like to trade everything? I think we do, because we never know what the future holds. We never know where the next outlier will come from. So I would say that yes, we would like to trade all the markets. Now the second question is the S&P index a market? Now I beg to differ with what Jerry just said. I think it is. Yeah, it's a basket. It's a composition of different stocks. If you trade the stocks there inside, you are covered for the S&P. Perhaps even better if you're layering a trend following system on top of those stocks. But I do think it has a life of its own, and there is a possible outcome. There is a possible future, a possible stream of events that the S&P gets a life of its own and shoots up, no matter what the underlyings are doing. It could be that, I don't know, perhaps people start trading the S&P on itself. I do know a couple of macro funds that trade the S&P and not the underlying stocks. So their positions their decisions are based on the S&P level and never mind the stocks there inside. Jerry just gave us an example that on the short side sometimes it gets whacked and because of positions of traders. And well, anyway, I do believe there is a possible future that the S&P can get a different outcome than the underlyings, just like the WTI crude oil gets a life of its own, different than Brent oil, and supposedly they should be the same, or heating oil and gasoline or whatever. There is a possible future that it can become alive. Now the question is, we don't live in this hypothetical scenario that we can trade everything. And now I connect now again, connecting with what Richard said. I think the decision comes down to if we could order the markets on a preference list, say, and say, well, what's the first 20 markets I would like to trade? Oh, these are the first 20. What are the next 20? And then you go down that list and see what your capital allows you to trade. And I think that's the relevant question. I think that's why Richard said, I try to see in the back test if something has at least gave me a hint that can show an outlier, and that's my criteria. And Jerry said, no, I don't care. Something can come up and get and show an outlier. And yeah, I can agree with that reasoning that perhaps the S&P is low on that list. It's a low position on that list. So there's a lot of things better than the S&P index to trade before. But I wouldn't rule out the S&P just like that. So I think I agree and disagree with you guys.
that I've got a concern with is that we talk about markets, and as trend followers, we're looking at these markets, each market having something unique about them. Now, when you come to indexes, there's a couple of things going wrong with them where I think, well, for a start, when I look at the distribution of the market distribution of returns for an index, it is different to the market distribution of returns to isolated individual markets like corn, like soybeans, like a currency, etc. That's because the actual index itself is a construction, which is effectively a rotational system that's looking at high cap weighted rotational system that's long only. That changes the nature of the distribution. So when you look at the distribution of market returns for an index, you find it's got a much greater left tail than it does the right tail. that therefore means that your systems need to be modified to take advantage of that difference. Now, because we want to trade the same systems, the same method, the same way across all of our markets, I think you need to almost take a view that you need to adapt your method when dealing. If you are going to be trading indexes, you need to remove the long bias that exists in the index construction by something like what Jerry's doing: trade long only individual stocks and trade short the actual index. That makes sense to me because it's actually making the tail regions more symmetrical in nature, as opposed to this different distribution that's produced by indexes. And the second thing about indexes and ETFs is that they're already diversified entities. S&P 500, Russell 2000, they're already highly diversified, but they're being diversified by a committee selection. They haven't been diversified through a process that we undertake through our trend following method. So the individual constituents of those indexes might be valid things to trade, certain amounts of them, but not the entire index, because that diversification that already exists in that index is diluting the nature of the outliers in that ensemble. So, when you look at the S&P 500, you realize that there might be 10 stocks in that S&P 500 that have sufficient liquidity to meet our rules of liquidity. The balance, probably regarded as illiquid in relation to our rules, and therefore, you might select Amazon, you might select Facebook, you might select Google or whatever because of the capitalization, and they're highly liquid, but they're sitting at the top of that index because of their performance. But the entire index itself, 90% of it is underperforming, and it's only 10% of it that's performing. So that committee that diversified that index has taken away those outliers from us through our process. So why trade something that's already been diversified when we can look at the individual markets themselves that as a composite in our portfolios makes sense from a diversification principle?
So what would an index look like if there was a trend following index? What would be the difference? If that might highlight as well.
Well, a trend following index. So when you look at the S&P 500, it is focused purely on equities. But if we start getting an ensemble of trend following programs, each of those individual programs have applied a trend following philosophy. Each of them are incredibly diversified in system and in market reach across many, many different markets. So they've already embedded those principles of trend following into their method of diversification. So it's okay to be able to create an index out of them because their rules, the philosophy, all of that process that's necessary for us to achieve our edge is already embedded in those models. So it's okay for us to create an ensemble of trend following indexes and trade the index, but it's not the same to trade the S&P 500 or to trade an ETF that's been diversified for a particular asset. So yeah, it's a totally different ballgame.
So could we say, in terms of like the S&P 500, is it, if I grapple with it, saying the trend following method versus the S&P 500, certain committee picked it up, would we say that in that case they use certain, let's say, convergent methods or alternative method that doesn't match with the trend following perspective? Maybe they put in a stock and they take it out at a certain time, which we wouldn't per se. Certain things like that, which collide with our rules, which makes it less, which makes the asymmetry or the chance of outliers on those less probable? Or am I looking at it wrong still?
No, that's right, Jay, because the way they construct the S&P 500 is that those that fail fall out of that index and they're lost from that index in their entirety. Now, for us, we'd be trading them short, the ones that were falling off. So there's this long bias built into those indexes, which is already affecting us as trend followers because we want to trade both long and short. So automatically now we've got to respond with models to have a long bias in our models to be able to trade that index, because the committee has decided through their process of selection and how they construct the index, how we should be trading those models. And we don't want to be sort of change our philosophy in light of what a committee wants. We want to do a diversification ourselves with our own process, long and short, with our particular method.
Yeah. That's another good point I forgot about. I mean, come on. How can you get around this? That if you looked at the markets individually, you'd be short some of those, long some of those in the index, short some of those in the index, and flat some. Come on. That's why I'm saying it's not a legitimate process. And then I'll be a lot more amenable to changing my mind when I see all of these CTAs and trend followers creating indexes. Or in Bruno's terms, maybe it's a market. So let's create some markets. Let's add the grains together. And let's trade the grain index. Let's only trade the dollar index or Asian currency index. Let's create them on our own. Let's get the research departments going. This is such a fruitful area to add markets. It's not ever going to happen. It's where our brains are contaminated by the media and what normal is. Trend following is not normal, but we love trend following. But we can't even get over that hump because we agree with currencies, we agree with commodities and interest rates, but our brain is like, stop right there. You've got to trade these indexes. You can do it with your trend following. And no, my brain is like, no, I'm not accepting what I've heard my entire life. I'm not going to accept these indexes. I don't care if they're another market. It's not a real market. I mean, we're not here to trade all the markets if some of them are not liquid, if they don't add a diversification, if they're located in Russia or China, maybe. We've got to be discriminating, or if it's an index on the long side where, for instance, I can get a hold of those components. We've got to make these I was going to say common sense. I don't like saying common sense, but we've got to make some of these choices as pure as I want to come across when it comes to real life. I'm more interested in making money and safety of my portfolio. So yeah, I will sell some indexes and not always do that many short equities. And I understand. I'm not going to argue that I haven't changed my mind or the people are right. They're calling me out on it. Yeah, you're correct. But this is what happens. Bruno gets an A. I gave Bruno an A+ for the class a few weeks ago. I was really bragging on him. Now his average grade is dropping, and it's getting closer to the rest of you guys. So, but that's okay. We'll see. We'll see what he can do in the future to get back to.
Pick your act up, Bruno.
Yeah,
Let's
okay,
go
I
to summer
deserve this
class.
one. I'm going rogue.
I love Bruno, but I have my standards. I'm not the professor like Professor Brennan, but I'm the TA, and I'm handing out the grades.
We're all fearful of you, Jerry.
It's the mean reversion kicking in. That convexity sucking Bruno down to our level.
That's deep.
Come on, Brian. No, that's a low blow, Brian.
I want to read a couple questions. We've got some good questions here before we leave. This is from Stephen. Thank you, Stephen. What are your thoughts on creating rules that take mean reversion into account when creating the stop loss and exit for a position? I don't really know how to answer that other than, when I plug in breakout parameters, the 100-day high, nothing shorter term than the 100-day high and the 100-day low, and then I'll use the stop loss. I'll test the stop loss in terms of ATR, 2 ATRs, up to 10 ATRs, let's say. And so I just mess with those three parameters, entry, exit, and stop loss, and the computer comes back and says, okay, this is the good area of those parameters, 100 to something and 3 to 10 ATR losses. And so then that's what I trade. I don't know if I'm taking anything into consideration about mean reversion. What do you think, Rich?
Yeah, so look, I do have a few what I call supplementary models which engage in a bit of mean reversion, but this is the thing. It's mean reversion on entry only into a trend. So the mean reversion principle is based on a predominantly, my core systems are breakout in method, but I do have supplementary systems such as what I call a mean reversion entry trader into trend, which therefore requires a bit of a retracement and then a return back into the overall trend, which will define an entry point. But it's not mean reversion in that it still has an unlimited no profit target. It's got a trailing stop. It's got an initial stop. So all it's doing is looking for an entry point with a bit of mean reversion back into a trend as a way to get into the trade. But then, like all of my other models, they all have these golden rules of letting profits run, initial stop, trailing stop. So it's just a means of getting a bit of entry diversification into my system ensembles as a supplementary system. But the key thing is the breakouts are essential because the breakouts help you avoid this type 2 error, which is missing the outlier. So if you're engaging in any form of mean reversion entry into a trend, it can mean that sometimes you might not catch an outlier on that particular system. So therefore, you do need a core level of systems that always participate in outlier events. And something like a Donchian breakout will ensure that you will never miss an outlier because the nature of the system itself ensures that you will be participating when those outliers occur. You might get many whipsaws, you might get, many false signals, but with the Donchian breakout, you know that you will never miss an outlier for that particular market. But once you've got that, you can use other systems as a means to get a bit of entry diversification into those outliers to capture what I call these different trajectories of that outlier.
I want to read one more question. This is interesting. It's from Michael, and I'm going to guess where this would be going if he was asking it. But the question, his comment was that tails are good only if they are in the direction of your position. The fact that market has tails alone is not sufficient for anything. Okay, exactly. That's so true. But it makes me think that there's a little bit of gap between our understanding here because, obviously we've got that covered, right? Well, hopefully most of the time we get this breakout and we get a big trend. Okay, that's good. We get a breakout, it's a loss. We take our small loss. That's good. And then, but let's say we buy a trade, we get in on the breakout, and then we have a massive loss against us. I don't think I've ever seen that happen. So to the extent that I would say, these outliers, depending upon your look back period, could be anywhere between 20 ATR to 200 ATR. A lot of mine are in the 200 range, 100 to 500. So I've never lost that much money, that sort of tail loss on a trade. Okay, so I don't think that's what he meant, okay? I think what he meant was that on some of these daily moves that we have seen, this is a tail move. The Swiss franc a few years ago, and in some ways, I think quants can calculate these and classify these moves as a outlier. It's not an outlier trade where we lost 100 ATRs, but we may have made money in that market, but there was a tail move within our trade that made us lose a little bit or lose a lot of our profit back or something like that. And I think that's sort of the difference between hardcore trend followers who look at things on a trade by trade basis and sort of try to ignore price action that in between the entry and exit dates versus more normal community of people who take a look, who look at all of the price action and don't close their eyes between, because most of my trades last a year. So technically my system is not caring what happens within that year, only that, hey, today's an entry, a year later, today's an exit. What do you think, Rich?
Yeah, I agree, Jerry. So, a lot of people say, oh, today was a 5 sigma event or something for a particular daily price move, but that's a daily price move. So would a trend follower participate in that? Well, no, they'd have to wait till a trend gets material in nature before they participate in that. But let's say that they were participating in that and they got an adverse price move, a 5 sigma event against them. Well, their systems have already got risk mitigation of their stops built in there, which might give them a degree of protection. But probably the best form of protection is a small bet size, which gives them ultimate protection in those adverse environments. The small bet size and the stop will trigger us out. We might get quite a lot of slippage with that event. But when we're talking about outliers, we're talking about a directional series of events that creates a significant outlier in the market data, which visually you can see as a massive trend or a massive exponential move over, many, many months, years even. It's that which we participate in, as opposed to worrying about the individual volatility that exists in the daily price moves. That's sort of a volatility sort of expression. That's not what we would refer to as outliers.
And just, yes, exactly. And then to continue, this is like one of the things that keeps popping up in my head, but I don't always talk about it. And that is how critical trade level calculation is. Because if that open profit was included in the trade level, then it's going to have a big impact on you, because you've based recent trades on that level of equity in your account that is evaporating quickly. So you've immediately taken on too much risk. Your capital's at risk because you're including all of the equity in the account. Where I've isolated that really unreliable outlier. That thing can be so volatile, it can go away, it can fluctuate wildly, but I've isolated it on its own. It's in quarantine, and it's not going to impact the rest of my positions, my new trades. I hope it goes well. It's usually there'll be huge contributors. I'll be eternally grateful, but I'm not going to count those chickens before that exit hits, because that could reverberate through my entire trading, my entire portfolio, and then I wake up one day and say, I've got to reduce positions because of this one era of including, increasing the trades, increasing the size of my recent trades based upon open trade equity. So once again, when you don't do that, all hell starts to break loose, and it's really hard for me to help, or hard for anyone to help you if you've made that critical mistake. I remember being so totally impacted by this plane crash back in the early 2000s or late 90s. I was watching CNN, and there was this plane crash. It was a famous plane crash, and it was just horrifying. And they brought this pilot on. I guess he was a journalist as well. And they said, what happened? And he explained what happened in this crash, this small plane. And he said, what do you tell people to do when they get in this situation? He says, I tell them, do not get in that situation. Because there are situations you get in, there is no help. You're too far gone. You didn't limit losses. You didn't diversify enough. You didn't use robust systems and techniques. You didn't go with the trend. You didn't have a lot of small bets. And you continue to pump up your trade level with fleeting open trade equity. Then what should I do in that situation now? No, it's too late. You have children. You've been raised by parents. They'll tell you, no, if you make these bad decisions, maybe life won't be over. You can always start again. You can always come back. But no, you've made these decisions. Now you have to live with them. We told you they were wrong. We told you to be conservative and safe, and you didn't listen. And now you have to deal with it and learn your lesson.
Exactly. It's all about taking responsibility.
I learned why I wasn't able to add certain people. It's because this thing limits us to 10 speakers. So I may kick people off if they're not speaking, and to add people who are requesting to speak. So no, sorry about that.
Jerry, just coming back to this point, I mean, this whole approach only works if you're willing to make a distinction between open and closed,
Hey guys,
equity.
if
If you can't,
do you
for some
guys
reason,
need?
sorry, Maurice, if you can't make that distinction, I think it becomes very difficult to to not have the problem that you're talking about, because as your ATR explodes, it drives your P&L, regardless of you
I'm not sure
measuring
if
it
I'm
against
actually
open
on. It told me
closed
that it's
equity.
limited to 10 people.
We've got a bit of a cross feed going here between Moritz and Bruno.
Yeah, I think Moritz is connection.
Keep going, Bruno.
Yeah, no, I was going to say the biggest problem I find in following your approach is this distinction you have to make. So considering that you have two equity accounts, one open and one closed, if you can't afford to do that, and in my approach you can't afford to do that, then you're going to have your outliers driving your P&L. And if you don't adjust your outliers as as they sort of drive your P&L, you're always bound to have the problem that you're talking about, i.e., one day these markets will revert back a little bit or a lot, and you're going to have a big P&L impact that might hinder your ability to survive. So again, I don't want to get into the diatribe and sort of the heated argument of should you control for volatility or not, and why you're doing these kind of things. But again, it points to that direction of sometimes your setup, your constraints sort of drive your risk management. And I know you don't agree with with the premise underlying this type of risk management choices, but that they're there to exactly prevent what you were describing for people that cannot afford to have two types of equity, two equity accounts, an open equity and a closed equity account.
Yes, I agree. That's exactly right. Trend following does force you, I mean, by definition, taking small losses and letting profits run, right then and there is, wait a second, are you saying to handle losses and winners differently? Yes, in every way. And so to me, it's more of like a huge benefit. We've concocted this new idea, and your big sacrifice is to treat the winners and losers differently and keep these two equity streams. Oh, I mean, that's not much of a sacrifice for me. I love that. That's perfect. And a little bit of gentle, or maybe not even that much gentle volatility management on the open trades. I don't really see where that would prevent me from carrying these two equity types, because honestly, I don't really believe the large CTAs who say that their heavy-handed vol management is strictly for risk management purposes. No, it's for taking profits, because they've done the back test like we all have, and the look-back period has to be 100 days plus, and waiting for that 100 days plus breakout level or the equivalent in moving averages to get hit is going to mean big profit givebacks. Clients don't like big profit givebacks. So out of these PhDs and out of these scientists, these self-proclaimed scientists, that's their driver. Clients don't like this. And so we'll under the guise of risk management, where there is no risk, we'll reduce these positions because of volatility, but it's basically serving the purpose of taking profits off the table, because waiting at their size and at their level of institutional investors, waiting for and just sitting back like I do and say, well, just watch these markets go against me and a lot of these profits be reduced, is just intolerable. They can't do it. But I don't really see why a bit of trimming your positions as sort of a tactic to smooth things out and book some profits would prevent anyone from looking at the two equities the way that I describe it.
Oh, there's no prevention, so to speak. It's just that you have to explain investors that there's two types of equity, and I don't think that works in a sort of instant mark-to-market world that we live in. Certainly has been my my experience, and I don't have many investors, but the conversations are always around can you tell us what your P&L drivers are, and what what you do to make sure that the revenue streams that you think you can capture are not being hindered by whichever market turns we might find ourselves in. So there's certain thresholds and certain levels by which one has to act, at least in my environment. And once again, I don't do daily volatility management. I probably do what would be described as soft. So I have an idea of how much volatility I would like to have in my what you call open equity. But at some point I have to act. I can't just say, oh, this is all mark to market. And again, it boils down to a business setup, I think, more than an intellectual setup. Though I agree with you that some people hired PhD to make it sound very fanciful and very intelligent. But I think it's a hard constraint that comes from business setup.
Yeah, and I don't think you need to explain too much. You need to sort of figure out your own clients and your business plans. And I think that's another mistake that I made over the years, is explaining too much and sort of saying, hey, I'm pure trend following. Isn't this wonderful? And they're like, no, it's not wonderful at all. And pretending the more of the trend following classic you can put in your clients' portfolios and walk that line of not too much non-classic in vol management, but enough that suits you and them. But to a degree, I don't really think anybody's requiring. It's not necessarily a requirement to tell them, like I did, this is how I'm going to do it. Almost defiantly challenging them to accept what this classic strategy. And the response was, well, yeah, I'm not going to accept it. So you don't get the money. People who talk nicer to me and talk the way I want them to talk, they're going to get the money. And even if they make less money, I don't care. It's smoother. And I don't care what you say about desiring things that are not smooth. But yes, and here's the point. As we've said many times, at the end of the day, all you can say to those people is, and all that they would say back to you, the more classic trend following approach that you practice, well, the guy does make more money. And that, at the end of the day, is all they're ever going to be able to say. You just got to make sure that's the case. And I firmly believe that with all the faults of the classic and the two equity approaches, that's the only thing it has going for it, is the CAGR is higher. And we're correct on that. And that's the best you can ever hope for. And they will grudgingly admit to that if they ever are a client, but most of them are not going to be clients. I'll have to apologize to Moritz because we had a foul up there on him talking, but we'll get him back next week. Is there anybody who wants to ask questions or say some things before we try to close it up around 10 in 4 minutes? Please go for it, or let me know if you want to go on stage.
I just want to say thank you and to remind everyone to love your system. And we know that we could be in a drawdown period, but remember, at the end of the day, your risk to stop is still profitable if you traded the system right and bought that initial breakout or sold that initial breakdown. So just because we're in a phase transition right now, it goes part and parcel with the system. It's what we love. Keep the faith.
Hey guys, I'm not sure if you guys can hear me or not. I've been trying to chime in when I could. You've answered a bunch of my questions already, so I got up on stage late. I had some technical difficulties, but I really appreciate these spaces, and it's just wonderful to hear from all the folks here. So thanks again. Okay.
Very good session here today. I appreciate it. We'll be back to next Friday, same time, and I appreciate everybody being here and the comments. And it was fun. We got into it. We got the stock thing. We got to get back on the stock indexes because that really got people fired up. That's a great fun topic to bat around with ourselves. So, anyways, hope everybody has a good weekend and a safe week. We'll see you next week. Thanks, everybody.
Speak to you tomorrow, Terry. Take care.
Thanks, everyone. Bye.
Thank you, everyone.
Thanks, everyone. Bye.